Listen, hey, we've got a really interesting session today, and our special guest is Janette. Give us a wave, Janette, so everybody can see you and say hello. Janette is a specialist market researcher with her own firm, and looking at the public's desire, need, interest in responsible investments for their pensions. She's done huge amounts of research into this space. A lot of times when we've spoken at E2W about ESG, it's got very technical, and Janette has got a different perspective on that because she looks at it from the public's perspective. I don't want to take too much away from you, Janette, but we've got about a half-hour presentation, I believe, and then go into Q&A. So listen, hey, I'm going to shut up now. Without further ado, Janette, welcome, and over to you.
Brilliant. So I'm going to share my screen. I'm going to pop that up now. So hopefully you should all see it. So thanks ever so much. I'm very pleased to be here today to go through this with you. So my background in ESG or responsible investment, I really started looking at this maybe about 5 or 6 years ago. I was asked to give evidence to the Law Commission when they did review of it. And at that time, I have to say in the industry, it was a bit of a niche topic area, and I would often go to conferences and be talking to the trustees, who are the people who sort of look after the money in the pension schemes. And we'd be talking about this and they'd be saying, no, it's not really very interesting. And actually, you know, my fiduciary duty, you know, the thing that I'm employed to do is basically to maximize returns for members. And I have to say, there has been a massive change in attitude over the last sort of 5 or 6 years, and really started off, I would say, probably about 2 years ago and ramped up since then. And now when I go to a conference, I mean, you're falling over yourself not to be talking about ESG. It's consistently one of the hot topics, if not the hot topic of conversation. And there's a whole batch of sort of issues for people to go on to sort of think about how they're going to integrate it. Should it be in their standard default fund? Should it be a specialist? What's going on? None of those things are my specialism. I sort of dabble in bits and bobs, but where I really come from is looking at it from the member perspective. And as was mentioned, what the member is you and me. We're all members of pension schemes. It's our money that the asset managers are looking after, and that the trustees are responsible for. So this is the ordinary, you know, man on the Clapham omnibus or woman on the Clapham omnibus, how they're feeling about it. And the reason why I get very excited about ESG or responsible investment, as we like to call it, because basically ESG is a bit confusing. Sounds like something nasty you get in your Chinese food, and members get very confused with the E bit of it and think it's ethical investing, whereas in fact it's obviously environmental. And so for responsible investment, I come at it from the point of view that this, perhaps in my career spanning 30 years, is the only time I've ever found people getting excited about their pension money. And I'll take you on a bit of the journey that we go through as I talk to them, and you'll perhaps see why. So the first step of the journey is to get people to understand what in pensions is all about. And I ask them, you know, what do you think investing is? And often it's a surprise to them. They didn't know that their pension money was invested. Oftentimes they just think it goes into some sort of bank account or a vault somewhere, or they're not really sure. And if they can give any sort of view or opinion on it, then what they'll do is reflect back to things that we as an industry tell them. Oh, wow, you know, my money could go up or down, or it's in these things called stocks and shares, but they don't really understand it. And they don't kind of understand that fundamentally they're buying into bits of things. And it's getting that message across that is the most powerful thing. So the next part of the journey is to ask them, well, what bits of things do you think that you have in your pension? And again, they don't really know. And it's a real surprise when they find out that they might have these sorts of things in their pension. So controversial weapons, fossil fuels, gambling, deforestation, tobacco. It's been a bit of a surprise, I have to say, for some trustees to find out that they're in these sorts of things as well. There was a classic example a couple of years ago in New Zealand where they found out that some of their pension schemes were illegally investing in controversial weapons, and I believe that the Bank of England has, the Bank of England, the Church of England has had some issues with pornography in the past. And so thinking about what's sitting in the underlying assets is a real eye-opener. But on the other hand, your pension money could be in these sorts of things. And that feels like a much better list of things that people would like their pensions to do. So there's about 3 trillion in DC pension money at the moment. And you and I and everybody else all own a bit of that. And collectively, we all own quite a lot of the companies. And with the power that's invested in us there, we can collectively make quite a difference. So the first thing I'm going to do now is stop sharing my screen and start sharing a video clip of me talking to some ordinary people about what they think their pension money is in, and you'll just see some of the reactions when they find out what's really going on. And I have to say, we described it in our report as a look of horror, and it really is. Just watch the body language of the eyes opening and how they're sort of touching their face and things like that. So here we go. Let me just share that again. Share sound. Hopefully this works. Okay. Here we go.
Are there any things that you feel like you definitely wouldn't want your pension money to go into?
Not that I can think of, no.
So
I guess maybe like, I don't know, companies that sell arms or something, which obviously they probably definitely wouldn't do anyway, but you know, something like that, something that's affecting society.
They definitely
in a negative way. Oh, they do?
In arms
and
tobacco,
oh, wow.
And you know, unless you do responsible investments and they're just up for investing in things to make you money, then they will invest in whatever that makes you money. So that could be arms, it could be landmines, it could be chemical plants that are polluting, it could be firms that are using child labour. I mean, it could be anything. If you haven't said, they're like, right, well, the only thing you're interested in is money. Is that how you actually feel?
No, I would. Yeah, absolutely. I would definitely opt in for a responsible investment. Yeah, absolutely. Even if it meant maybe slightly less money, I think I'd rather feel better than investing in a company that sells landmines or something like that.
Oh, what current that's happening?
Currently.
Oh no, I wouldn't like that. Yeah, I wouldn't want my money to be invested in gambling or controversial weapons. Yeah, no, that is important to me.
I want to know what companies don't responsibly invest now. Do you know,
so
that's making a big thing.
I'd be really surprised if you've not ticked a box to do ethical investment. You're probably investing in all sorts of things.
Oh, see, that's worrying. Yeah. Obviously, I'm going to go and have a look now because when it's put in front of you and you think, like, what other money is invested apart from pensions? Is there other?
Not really.
No, it's just pensions. Oh, okay.
Yeah.
Oh, I'm gonna have a look through my thing because I didn't realise I didn't. But I want to know what companies don't do it now.
So that's just a really small glimpse at the sorts of reaction that I get when I do this kind of research with people. And they're just ordinary people. There's nothing special about them. I haven't particularly picked them, to have a view one way or the other. And that's sort of feeling that they have. So looking at sort of survey data, we do a survey of 1,000 members, and we've been following the same questions over time. And what we've been noticing is that the sort of backdrop of interest in ESG issues continues to grow. So between 2018 and 2020, you can see that the question, businesses have a wider social responsibility than making a profit, has gone up from 81 to 87% agreeing with that. Thinking about the importance of protecting people who are vulnerable in society has gone up from 74 to 83. And and thinking about worrying about the state of the world and thinking that they can make a difference has gone up from 59 to 66. And what we're seeing there is a slight tilt. So environmental issues and executive pay are kind of staying about the same, but members' interest in what we call the S factor, the S in ES and G, seems to be on the increase. And we're going to track this question again this year and see if that was something to do with the pandemic, which obviously hit us in 2020 about the time we did the survey, or whether this is a longer term trend and people are sort of there or thereabouts with climate, and the S issues are sort of rising up the agenda. And perhaps these sort of things aren't really that surprising, because we ask people about their activities in their day-to-day lives, and you can see from this sort of wheel, recycling plastic is very popular, they're recycling waste. You sort of go round, and some of the things that are surprising to us is, you know, compared to 2 years ago, 53% of people are more likely to avoid products which contain palm oil, 45% of people are more likely to eat less meat or dairy products, and you know, we've even seen 62% of people trying to buy from more sustainable brands such as fair trade. So certainly when I talk to people now, there's a lot of talk about electric cars being their next vehicle of choice. There's a lot of people talking about using bikes more, especially since the pandemic. But there's an overarching sort of sense of frustration that whatever people do at an individual level doesn't really scratch the surface. And this is why when you start to talk to them about the power that pensions can have, this sort of collective use of money, that's when the dial starts to shift and engagement levels start to go up. And so 7 out of 10 members, so ordinary people who are in defined contribution pension schemes today, are now interested in responsible investment, and we've seen that number grow over time. And whereas previously we had seen that there was a little bit more interest in the sort of younger generation, and typically as this sort of topic area progressed, people started to think this was just a kind of a millennial issue. You know, they would be the most interested people in this, and there's probably some truth to that. But what I would say is that we're starting to see those generational differences narrow over time. And I think there's a couple of reasons for it. I think certainly on the climate side of things, I think people are starting to, older people, you know, I would say boomers, etc., are waking up to the fact that whereas they thought this was going to happen in their children and their children's children lifetime, that's just not so. They're looking at the weather patterns, they're looking at extreme events, and it's happening now and it's real, and they're starting to get really worried about it. And then when we talk about things like gender equality, and that sort of thing, you know, they relate it back to their own family members. They've got daughters, they've got granddaughters. They want to have equal opportunities for their own members of the family. So we're starting to see this sort of spreading across the generations, and that's a real powerful message for my industry, the pensions industry, because obviously the older you are, the more assets you have under administration, and that's where the money is. So if you start to get the older ones excited about it, then you're onto something. So as I said at the beginning, this is my area where I particularly get interested in the power of ESG, or responsible investment in pensions. And this is all about the holy grail of getting people interested in their pensions. I mean, we are an industry that is built on inertia. I mean, people are not interested in their pension money until very, very late. You know, I often find that people don't even know what they've got in their pensions until about 3 months before they're retiring. And so when you talk to people about pensions, they'll use words like, oh, it's just a tax, or it's a necessary evil, or you've just got to do it. And it's all that kind of negative stuff. And there's an awful lot of mistrust in our industry, and particularly, I would say, amongst the older generation. And they've been through the Maxwell scandal, they've been through the BHS scandal with Philip Green. You know, they constantly hear things are changing. You have the WASPy women, where state pension was reduced for them. And so every single change that happens to pensions is negative, and it just erodes trust. And this does filter a bit down the generations as well. I hear that. You know, do I really trust that my pension is going to be there when I retire, because it's such a long way out? And so for me, looking at these sorts of numbers, you know, the impact that climate friendly funds, if you want to go down that specific route, or responsible investment, can have on trust and engagement is amazing. 71% of people saying that responsible investment would make them feel more positive about their pension. 75% saying it would make me feel more positive about the way it's invested. 65% saying I'd have more trust in my pension. I don't see this with anything else at all. And we test a lot of things. And interestingly, 67% saying they would like to engage more, and 50% saying I'd like to pay more in. Now that is an interesting finding. Partly it's an interesting finding because we're looking at the commercial aspects of this from the pension provider and the asset management industry. But partly we're looking at it from an adequacy in retirement. Auto enrollment at the moment, which is the government scheme, 8% of contributions, is not going to scratch the surface. You probably need to be paying around 20% of your pension in to even get near to having a decent retirement living standard. And so anything that we can do to help people to pay more money into their pension has got to be a good thing for member outcomes. And so these statistics and seeing this increase from 40% saying it'd make me want to pay more into my pension in 2018 to 50% saying that in 2020, I'm very pleased when I see those sorts of numbers. So often the argument against responsible investment, and we hear this from the member side of things as well, from the ordinary people, is, well, I'd really like to do this sort of thing, but it is my retirement money, and I wouldn't want to do it if there was too much of a cost. And you heard, as we go on this journey of discovery and people sort of find out a little bit more about it, people start to say, well, I don't want those things. I might be willing to take a little bit of a hit on that. And certainly the statistics that we're showing there, I think it's 55% of people would be willing to accept a lower financial return in the shorter term to achieve higher long-term financial returns with responsible investment. So over half of the membership will take a financial hit. And when we explore that in a bit more detail, well, what do you mean by that? How much of a hit? I mean, people are not very good at working that sort of thing out, but generally they'd go for a sort of 5% dip in the overall value of their pension, which in the asset management world is just huge. Like, we're not even going anywhere near those sorts of numbers. So, that is perfectly acceptable for them. But that's quite an old-fashioned way of thinking about things. There's an emerging body of evidence from the academic side of things. I think Barclays did a big meta study, and there's some real-world data as well. And I'm just showing you there. I think that's LGIM's Future World Multi-Asset Fund against a standard multi-asset fund, and they're pretty much the same. There's no, in fact, sometimes they do better. There isn't a premium to be paid now to have ESG. And so it's flipping the mindset of trustees away from that old-fashioned message. And I think it's taken a while. The investment consultants have taken a little bit of time to catch up. But I think that message is being pumped out a bit more now. And I think it's giving them the evidence around that to work it out. On the flip side of things, again, we have to be a bit careful because there is a lot of greenwashing that's going on. So people are saying that they're, in a responsibly invested fund, they're doing all these things, and are they really, and are they doing it in the same way? And if you go to a conference where this is being talked about, there would always be a data provider there talking about how they do their scoring, and there's all sorts of issues about inconsistency in scoring. So there's still a long way to go on the sort of technical side of the journey, but certainly from the members' perspective, we know that responsible investment probably doesn't need to come at a price, even though many members would actually be willing to pay. So once the cat is out of the bag and they know that responsible investment is a thing, it's really powerful. And I'm just wanting to share another video clip with you very briefly of the people that we were speaking to, what their reactions would have been if they found out that their scheme, their trustees had said, no, don't worry, it's not in your interest, we're just going to go after returns, and that's all we're interested in. We're not going to do this responsible investment thing. So let me just stop sharing that with you. Just pull up the next clip. Just bear with me for 1 second. Okay. And there we go.
I don't really know what to make of that, to be honest. I think we should have a choice. I think they should be able to take into account the personal preferences of each and every member. So if you want our money, then you should be willing to put it where we want it, or not have it. I don't think they have the right to say no.
That's not very moral. It's a bit it's saying, you know, that's just too limiting and too much hard work, it seems, to sift through and separate the ethical from the unethical, and we just want returns, and we're going to pursue all angles that we think will maximise those. I think it's sort of financially driven, and perhaps these are morally driven, but with finance as a secondary aim, not primary.
I don't really know if I agree with that, because I think there could be like a middle ground. I think there's obviously a lot of companies that are going to do really well that are responsible. I feel like it's a bit of a cop-out. It's like not really making an effort.
I think it's lazy.
Okay, so there's some quite powerful reactions there, and if you can imagine me sort of standing up in a room, you know, in the JP Morgan Grand Hall and presenting this to a lot of trustees who are in the room, and they start to slide into their chairs at that point. They're really powerful clips. And I guess the key message there is that we shouldn't, as an industry, confuse ignorance with apathy. You know, once you inform people about where their what investing is, where their punching money is, where it could be, what it could be doing, then suddenly it's a whole different ball game. So the last couple of things that I just want to wrap up with, a couple of initiatives that are going on at the moment in the industry to try and get that message out. So the first thing is, I would guess you would call it a campaign. It's called Make My Money Matter. It was set up by Richard Curtis. And in all of my 30 years working in pensions, I honestly never thought that I would see Gary Lineker tweet about pensions in my life. But there we go. So he's got his celebrity mates on board. And he's looking at trying to make pensions more environmentally friendly. So he's really focusing on the E bit rather than the S and the G for now. But I mean, he's got Mark Carney. He's been on Breakfast TV. You can see all the sorts of the things there that are really making a difference. And so I would say certainly on the environmental side of things, he's pushing on an open door as far as members are concerned. The Greta Thunberg effect, you would like to call it, is really creating an awareness of how climate issues can impact on pension savings. If you look at the numbers there, the percentage of people, ordinary people without much knowledge, who believe that climate change will adversely affect the long-term investment performance, and therefore the performance of my pension scheme investments, if not properly managed, has gone up from 51 to 62%. And you can't really argue with that. And also people understanding that long-term investment performance will be constrained by the world running out of natural resources, and that investment managers seek to mitigate these issues when investing my pension savings. The number agreeing with that has gone up from 52 to 64%. So again, these are quite powerful statistics to take us on the journey of saying we should be thinking more about this, and it's what members want. And so just to wrap up, part of that journey that Richard Curtis and others are taking members on is to get them to sign up and put pressure on the industry to turn your pension money, my pension money, everybody's pension money, net zero. And so because they're much better at doing this sort of thing than the industry historically has been in terms of communication, the tagline is your pension a net zero hero? And you can go onto their website, anybody can, and they tweet about it all the time. You can look select your pension provider, see if they're already a net zero hero, and quite a lot of them are. So Nest, for example, has signed up, Elgium has signed up, Aviva. And if they're not, then there's a little box to tick that says, I would like you to be a net zero hero. And they're constantly putting that data back to the providers to affect change. And they're having some success, and then they tweet out firms that have signed up. So even last week, I think firms like Brewdog had committed to be a net zero hero pension fund. But it's not just about climate change. We've seen that there's interest in these S factors and the governance factors as well. And here, the fintech industry may come to our rescue on this one. I just wanted to share an example of something that's happening at the moment. So there's a firm called Tumelo. And if your provider signs up to them, then basically the permissions are shared. You as a member set up an account. You can then see which companies your particular pension fund is invested into. You can have a little bit of a look, see what kind of sector they're in or what they're doing. But the really interesting thing about this, and this is the sort of inclusive capitalism part, is that they start to list out all of the votes that are coming up at the annual general meeting. And whereas traditionally a pension fund had to sort of second guess how it should vote on behalf of its members, with this particular app, the members have a say. And it's very simple. It's a kind of yes, no, agree, disagree kind of Facebook type thing. On the issues at hand, you have your vote, they get added up. And then Tumelo pass that details back to the pension asset managers who enact the decisions. And so we've really got, capitalism going on right at the heart of pensions, inclusive capitalism, and we've really got members now taking interest, and they've piloted it. We've piloted it with RBS and a couple of other firms, Tesco's as well, and the take-up rates have been pretty good. So I'm pretty hopeful that this, plus other things, will start to really shift the dial on engagement there. So that's where I kind of wanted to end. I hope that's been a sort of an interesting trot through my world of talking to members about this really important topic area, but also to give you a bit of a flavour about where we're going as an industry, and what the next steps might be. So I'm really happy to take any questions or open it up to discussion.
Janette, I have a question, if I may. If that's all right. Is that all right, Mark? Can I fire off?
Go away.
It's from an investment perspective, and to give you a bit of background. So I work in sales at Fidelity, so selling investment products, and we're starting to do a lot more on the sustainability side. And one objection I commonly come up against, which I don't know if this happens in the DC world as well, and if you've got a view on it, is that sustainable investments and impact investments tend to have quite a quality kind of bias inherently within them. And if you are trying to build quite a balanced portfolio, you might not want too much of that quality bias coming through. And therefore, it's more difficult to build a more balanced portfolio in a sustainable sense, or an impact sense, than it is in a non-sustainable sense, which I know we shouldn't use that terminology. I just wondered if you had any kind of thoughts, views on that, because it's a topic I find quite interesting.
Yeah, I mean, I'm not a technical expert. I'm not an asset manager. I hear this all the time in the conferences that I go to as well. And generally the pushback that I hear is, well, people are doing it and they're doing it already, and you're going to get left behind the curve. And some of the biggest pension schemes are moving in this direction. So, as I just said, Scottish Widows, Legal and General, they're all moving to net zero. So if you're not offering a net zero fund, that's tricky. Now, clearly, you've got to be careful about the greenwashing element of it and proving that to trustees, but that's a completely different issue. And yeah, it used to be sort of wrapped up in this sort of value versus values argument. And people are generally tending to move away, well, as far as I can tell anyway, people are moving away from that and recognizing that actually, better run companies make better investments, and that's how it's going. And that sort of argument seems to be falling off a bit, apart from, perhaps in the retail environment. And one of the things that I have found is that, because we obviously a lot of this is on the institutional side, if you like, but I have also tested some of this out with people who have financial advisors. And they're like, well, my financial advisor asked me 1,000,001 questions about what risk I wanted to take and never touched on this kind of thing at all. And they're absolutely outraged by it. And I think we need to push it down that spectrum. And that's probably where you're getting a lot of your pushback from. And I think the financial advisors are probably where the trustees were maybe 3 years ago.
Yeah, I think that's fair. And I think it's probably true of a lot of the wealth managers as well, particularly the smaller, more traditional wealth managers. So yeah, no, that's fair observation. Thank you.
Can I ask one around the net zero hero bit? So I love the idea. I think it's great. But how does that work when you've got sort of the big oil majors, for example? They could be the ones, if they make improvements, they could be the ones that make the biggest difference to climate change. But they're not going to be net zero for some time. So how do we balance, how are you balancing that? Those that have the aspirations are not actually ploughing the money into doing this versus, their current state.
Yeah, so I can't answer that because that's more of a technical question. But what I can talk about is whether the divestment part of things. So the trickiest bit that I come across, and the bit that I talk about with members as well, is okay. So you've got an oil company, or a coal-fired station out, or what do you want your asset manager to do on your behalf? In effect, should they simply ignore it and say that these are generating pretty good returns for now, and that's fine? Or should they, on the other hand, divest completely and move all the money out? Or should they work with that firm in the middle to try and move them to a more sustainable platform, maybe talk about renewables, all that sorts of things? And invariably, I have to say, the members take the middle line. They say, well, they can't just ignore it, and particularly on climate change or modern slavery, that's unacceptable. And they don't want people to take their money out because they say, well, somebody else will just invest and then the problem doesn't get solved. And there's always somebody who's happy to put their money into that sort of thing. And so what they really want is that sort of, working with the firms to make the difference. And I think that's probably where the industry is going to go on that. So in terms of net zero, how you balance that off, you'd be looking at renewables and what the other sorts of things are that they're doing. But because we're looking not to add any more carbon, it's not moving to a zero position. But over time, I think members will want more and more sort of infrastructure building going on to do the green revolution. And actually, there's pretty strong pressure on the pensions industry from government to move in that direction as well. So in the statement of investment principles, firms now have to look at climate risk as a risk factor for future returns, and start to decarbonise their portfolio. And also, I think the government's pretty keen on using the sort of £3 trillion that's in pension money for the green revolution, for all of this new stuff that we're going to have as we make that transition.
Thanks, that's interesting. Thank
you. Have we got some more questions?
Sorry, I can ask one. Janette, when you test or talk to all these people, do you ever talk to them about that stewardship angle, or is it more about the carbon impact? I'm just not sure how much people understand that there can be that kind of, or investment managers have that power to kind of educate these companies.
Yeah, they don't understand it at all, Karen. I mean, they don't know that they're invested, and then they don't know that what investment means. They often equate the asset management industry to gambling, so they'll use the same language.
Yeah.
So it is a bit of a journey to go on, but it's not that much of a journey. You just have to say, well, if you own your pension is invested in a bit of a stock or a share, and this is what it means, and people are trying to get that message across. So I think for me, that's where the Tumelo app can really make the difference, because there you're putting that stewardship kind of thing right in people's faces. It's very sort of X-factory. It's kind of, we're all used to voting on things. It's putting them in touch with issues that they're interested in, so they can start to filter it down. And I have to say that the pilot schemes, as far as I can tell from the data that's coming back, are clearly more interesting to the younger generations than the older, but there is a good sense that this is something that's useful and will be used and on an ongoing basis as well. So I've got my fingers crossed that that's where the sort of fintech industry will help. But I also think that providers and employers have a duty of responsibility to get the message out in a much more powerful way than they have done at the moment, because we hear people in our research talking about their employers and how, their employers are talking about sustainability targets and diversity and all the rest of it, and have never mentioned this about their pension money at all. And I think that's a huge gap that we have to fill.
Janette, on that subject, obviously, we talked about the E and the S. In terms of the G, the governance, and particularly diversity and inclusion, have you asked members of the public about diversity, and do they care?
Yeah, they do.
Yeah,
they really do. So
okay.
We've asked them about, and particularly just sort of gender diversity, and they usually cage it in the kind of the usual, well, it should be the right person for the job, and you just wouldn't want to put a woman in just because it's a woman. But you kind of, as I said, they've got daughters and wives and granddaughters, and they are women themselves, and so they get very het up about it. I have to say, the issue that is the most climate change often is quite, people get very animated about that, but setting climate change aside, it's modern slavery where people really get anxious about what their pension money is doing there, and are totally surprised to hear that Boohoo, for example, has had issues with it, but then they think, well, how on earth could I buy that clothing item that I did last week for like 10 quid and then throw it away? So there's a whole education piece going on that I think we need to do.
Okay.
Do you have a view on what asset managers and I suppose advisors and wealth managers and consultants could be doing more to help this? I mean, I don't work in the DC world, but I can recognise that actually there's a lot we could be doing as the kind of stewards of assets to help ultimately and to maybe educate a bit more. So I wondered if you had a kind of call to arms for us all to be, and what we should be doing.
Yeah, I mean, the number one thing is, start reframing pension money, save investing, start thinking, helping people to think of investments in a different way. Stop them thinking about it as just you guys gambling and earning lots of money in the city, and start them thinking about the fact that it's inclusive capitalism. They own bits of companies. Once you make that light switch moment, once people realize that, that's the start of it all. And we're absolutely appalling, because it's not in any of the literature. All you ever do is say your money may go up, your money may go down, and that's it. Stop talking about risk as much, and we still have to do it, but try and reframe it slightly to talk about what fundamentally this is. And I think trying to get that message across, I think that's why, and start to do it in an engaging way. I mean, there's no point whapping this stuff off.
It's really interesting and good. We have to tell people stories. That's how the human race has developed. We love a story. Like, I do presentations, nobody ever remembers a word I say. They remember those video clips because it's stories and it's real and it's people, and that's what we have to do.
Anna, when you're out talking to your IFAs that you're working with, if you went in and talked about responsible investing and ESG, and how much airtime do you think you get? How do you think they're really engaged?
Mark, it's a really good question, and I don't know what others' views on this is. It's a really diverse set. So I find the kind of larger wealth managers, the larger IFA groups, tend to be a bit, I'm going to say modern, and I don't want that to sound an offensive term, but tend to be more on the forefront, and also can see that because of regulation, there is a weight of kind of money moving this way. and so they're getting on board with it, setting up kind of discretionary models, particularly that are sustainable. So I do think there are some firms, both on the wealth manager and the IFA side, doing some great stuff here. I'm really engaged on it. There are what I'll call the old school ones. In my experience, they tend to be the traditional stock brokery type wealth managers, IFAs, and I think they're less engaged. And it may be that, but that may be because their client group is different, and so their client group is less engaged, and maybe their demographic is different. But I think there's a real spectrum there, Mark. Actually, that there is some real openness to thinking about this, and some recognition, to Janet's point, that you don't necessarily have to sacrifice returns to invest sustainably, and you can do good with the money that you invest. But there are others that still don't quite take that view.
Thank you. I was one of the things, Janette, that you were talking about there about most people think of their pensions as betting on a horse race or something, and actually we should recognise how much power we've got, and collectively we can make a difference, and we need to stand up more. Are people, those people that you interview, etc., do they go away and do anything? And what do they do?
We do, and that's the shocking thing. So normally when I do market research, we have these chats about whatever it is, and they're just like, oh, well, that's fine. And then they go away and they do absolutely nothing. Oh, I might look at my statement, but they don't. So I've made it my business to follow people up. And the lady that you saw, I call Mrs. Sparkly Top, she said, oh, I'm going to go away and find out about this. And she got, quite animated about it. She was a single mom. She worked in a shop, the best will in the world. She wasn't the brightest. She was totally not engaged with her pension when she walked in the door. She was totally shocked when she walked out the door. 2 weeks later, I phoned her up and I said, oh, you're going to have a look and see, what your pension is doing. She was with Aviva. She said, I did. I went onto the website and I couldn't find a thing about it. And that's the problem that we have as an industry. We can get people riled up about this, but we have to give them the tools in a simple way so that they can find out one way or the other. And that's where I really like the Make My Money Matter campaign, because it's simple. You can see it. It's on the website. You can see who's a net zero hero and who isn't. And then the firms can use that kind of tagline or logo on their communications materials, and then the message starts to get across. And I think that's where we've been, for all the good stuff that goes on, it's no point sticking it in a statement of investment principles that nobody is ever going to read. They have to get that message out there in a very user-friendly way.
Yeah. So go on.
Sorry, Mark. Just touching on that point, I did want to ask, like what you mentioned at the beginning with the point of inertia. Like, do you have any data around that as to why there is that the passive culture, I guess, in terms of people being more granular in terms of where they are actively investing and going deeper in terms of their due diligence, if they really are
so I don't,
in that sense.
Yeah, you would never get an ordinary member into asset management as into actively selecting. So you look at a pension scheme, there'll be a default investment, and over 90% of the members will be in the default, and that's never going to change because very few people understand it. They don't want to know about it. They're not confident to do it. It's way outside of their area of expertise, and it takes an awful long time, and they just much rather delegate it and leave it to the experts, which is why I focus most of my attention not on getting members to think about the investment strategy. That's not their job. It's the trustees and it's the asset manager's job to think about that. And that's why this has got to be in the default. If it's not in the default, there's no point having it. And that's why we're seeing the net zero hero stuff being integrated into Nest's default fund, Scottish Widows default fund, Aviva's default fund, just so that the members don't have to make that active step. It's just done for them, recognising that we're an industry built on inertia, and that's not going to happen.
Yeah, great, thanks.
Janette, I've got one more question. At what point, so as an ordinary investor, and you mentioned the word greenwashing earlier on, it's really, really difficult to make a decision on whether, what company A is telling you and what company B is telling you is true, and how to compare them. Are there any moves to get some really good standardization across this, and how we measure ESG factors?
Yeah, so I don't think it's ever the job of the member to do that. So in a trust-based scheme, that's the role of the trustees, and in a contract-based scheme, that's the role of the investment governance committee, and we should just leave it to them to do that job, right? So that's where I come from on that. And in terms of we talk about ESG, and this issue of data is the biggest bugbear. Consistency of data, consistency of scoring. And I believe that there are moves afoot to try and get a bit more standardization, but whether or not what the timescales are for that, I don't know. So in the meantime, you will have, somebody like Boohoo scoring quite highly on one side of things and quite poorly in another index, and people recognize that, and there are moves afoot to try and fix it.
Good, thank you. Do we have any more questions out there for Janette? Now's your chance, step forward. Then Janette, I'm going to say brilliant, thank you, really interesting session. And thank you for taking the time to come along and share that with us. I think insightful and interesting, a brilliant session. Thank you, and thank you, everybody. Thank you, Katie. What have we got on next week?
We are joined by a friend of E2W who will be discussing operational resilience. No, that's wrong, isn't it, Mark? Where are we?
Come on, Katie.
Yes, operational resilience. Yeah, I had a question myself because I had to flip over into June. So that's really exciting. So she's coming in, doing a virtual coffee break. So similar format to this. There'll be a small presentation. So that'll be a really great one. So if you can attend that, please do.
Brilliant. Thanks, Katie. Thank you. We've also, in a couple of weeks' time, got our Alpha Careers Club, the next cohort of the Alpha Careers Club kicking off. So I know some of you on the call have been on previous cohorts. Please do come along to one of the sessions for the Careers Club and introduce yourself. They are women who were where you were a few months ago, in terms of looking for roles, and your help would be much appreciated. We've also, and I put it in the chat, 24th of June, really excited because we have the opportunity to meet each other, some of us for the very first time. So do come along. We're selling tickets quickly, and we've only got a limited number. So if you're interested in coming along and meeting other members of the community, please register as soon as you can. Otherwise, I'm going to, unless anyone's got any questions, say a final thank you to Janette. Thank you, Janette. Katie, thank you for putting this all on. Brilliant. Listen, see you all next week. Thank you very much.
Thanks, everyone. Thanks, Janette.
Cheers.
Thank you.
Okay, cheers.
Thank you. Bye. Bye.